It's no question that mortgage rates are top of mind for many home buyers right now. As a result, if you're thinking about buying a home for the first time or selling your current home, there's two questions you're going to want to know the answer to. Why are mortgage rates so high? And when will the rates go back down? Well, let's take a look at that. So why are they high? The 30-year fixed rate mortgage is largely influenced by the supply and demand for the mortgage-backed securities, MBS. According to Investopedia, mortgage-backed securities are investment products similar to bonds. Each MBS consists of a bundle of home loans and other real estate debt brought from banks that issued them. The investor who buys a mortgage-backed security is essentially lending money to home buyers. So for 50 years, the 30-year mortgage rate has moved in unison with the 10-year Treasury yield, as you can see on this graph. Last Friday, mortgage rates were 6.875. That means the spread was 3.2%, which is almost 1.5 over the norm. So if the historical spread was correct, mortgage rates would actually be 5.375%. That would not be bad at all. So why are mortgage rates still so high? The only time the spread approached or exceeded 300 basis points were during times of high inflation or economic volatility, two things that we're experiencing. Last time we saw this was in the early 80s and during the great financial crisis of 2008-2009. You can see this graph shows how the spread has come down after each peak. The good news, that means there's room for mortgage rates to improve today. So, what's causing the larger spread and making mortgage rates so high today? The demand for mortgage-backed securities is heavily influenced by the risk associated with investing in them. Today, the risk is impacted by broader market conditions like inflation and the fear of potential recession. The Fed's interest rate hikes are going to try to bring the inflation down. Headlines that create unnecessary negative narratives about home prices and more. Simply put, when there's less risk, demand for mortgage-backed securities is high. So mortgage rates will be lower. On the other hand, if there's more risk with mortgage-backed securities, demand for MBS will be low and we'll see higher mortgage rates as a result. Currently, the demand for MBS is low, so mortgage rates are high. Over the last several years, we also saw the government actually being the main buyer for mortgage-backed securities, and that's no longer happening. So, when will rates go back down? That's what everybody wants to know. Well, it's reasonable to assume that the spread and therefore the mortgage rates will retreat in the second half of this year if the Fed takes its foot off the monetary tightening pedal and provides investors with more certainty. However, it's unlikely that the spread will return to its historical average of 170 basis points, as some risks are here to stay. So the bottom line is the spread will shrink when the fear investors feel is eased. That means we should see mortgage rates moderate as the year goes on. However, when it comes to forecasting mortgage rates, no one can know exactly what's going to happen. So we'll just have to wait and see. This is Jeff Greavy. I'm Principal Broker of Weichert Realtors Advantage Plus with 2 offices in Knoxville to serve you. We look forward to working with you whether you're looking to buy or sell a home. I hope you enjoyed this information and stay tuned for the next video.